Welcome to Access Moneynomics by Access Mutual Fund.
Did you know between July 2018 and July 2023, assets under management for mutual funds rose by 108% from around 23 trillion to INR 46 trillion. This talks a lot of Indians that are making mindful decisions about their money. Remember we discussed about mutual funds in the last couple of episodes? It's now time to know how you can get started with your investment journey. Hello and welcome to another episode of Access Moneynomics. This is your host and money mentor Rashmi from Access Mutual Fund. In this episode, we will deep dive into the vast ocean of mutual funds and help you get started. If you are listening to this podcast for the first time, we would recommend you to follow the podcast for a regular dose of personal finance. Let me tell you, getting started with mutual funds is no child's play. Just like a child has to choose an ice cream from so many flavors, we as adults also have a buffet of mutual funds to choose from. But there is a difference. Well, while all ice creams may be sweet for the child, not all mutual funds might be right for you. You may already know that mutual funds pool in money from many investors, which is managed by experienced professionals. If you are wondering how mutual funds work, I'm pretty sure you missed out our previous episodes. You can go back, get a quick refresher, and hop right back in. Now, within mutual funds also, we've got plenty of flavors like an ice cream shop. Mutual funds can be divided into open-ended and closed-ended mutual funds. An open-ended scheme is open throughout the lifetime of the fund, and the units of that mutual fund can be bought or sold at any point in time, meaning you can enter whenever you want and exit whenever you want. A closed-ended mutual fund can be purchased only at the time of launch and can be redeemed only at maturity. For example, a fixed maturity plan would be a close-ended one. Another way to classify mutual funds is actively managed funds and passively managed funds. Actively managed funds, as the name suggests, are actively managed and monitored by a fund manager as to when to buy or sell or hold on to the securities in the portfolio. Whereas passively managed funds usually follow a market index. Here, the funds are allocated according to the movement of the market indices, like you might be knowing Sensex, Nifty, and so many other market indices. Think of exchange-traded funds and index funds for that matter. Mutual funds can also be used to invest in any underlying asset class like equity, debt, hybrid, money market instruments, real estate, and gold. So there are equity funds, debt funds, and so on. Hybrid funds invest both in debt as well as equity. Now, how do you get started? Say you decide to invest in a mutual fund scheme. This should be in sync with your risk profile, short-term or long-term goals, that's the tenure of your investment, and financial plan, which, if you remember, we discussed in our previous episode. Now, once you have chosen the scheme, you can invest directly on the fund house's website or through a mutual fund distributor. Select your mode of investment, whether it is lump sum or SIP, which is systematic investment plan, and complete all your KYC and bank formalities. That's it. Pat yourself on the back as you have just invested in a mutual fund. Easy, right? Well, hold on, because there are just a couple of more things that you might want to know. When you select a mutual fund, you will come across a term called net asset value. Now, what's that? Well, just like stocks have a price, mutual funds have NAVs, which is net asset value, which fluctuate every day based on market movements. Once you invest in a fund, you will be allotted some units of that fund. A unit represents your percentage share in that fund. Also, there is no guarantee of returns while investing in mutual funds. They are totally subject to market risk, and past performance does not guarantee any future performance. You see, investing is like planting a money tree. You water it, nurture it, and watch it grow. It won't sprout dollar bills overnight, but if you stick to the plan, there is a good chance you will achieve your goals in the long term. To summarize, you can choose to invest in mutual funds and build a diversified portfolio with ease. Ensure that your mutual fund scheme is aligned to your risk return preferences, investment horizon, and goals. And that brings us to the end of the episode of Access Moneynomics. Thank you for tuning in. If you found this episode helpful, don't forget to subscribe and feel free to share it with your friends who are exploring the world of investing. Remember to follow our podcast Access Moneynomics so you don't miss out on any interesting topics, which by the way release every other Friday. Until then, this is your host Rashmi signing off. You just listened to Access Moneynomics by Access Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.